When equity markets fall, people worry about how long it's going to take for them to recover, because we know it's going to recover eventually. It's a question of when rather than if, but if it takes a long time, your annualized return will be smaller. So in this video, we're going to look at what discriminates between long recovery periods and short recovery periods, and also where we should be right now in terms of recovery time. So let's look at recovery time for equity markets in a bit more detail. This video is sponsored by NordVPN, an app that lets you securely connect to the internet across all of your devices from anywhere in the world. One way to characterize stock market crashes is according to their length and also their depth. Now, sometimes I talk about the ulcer index, which is a measure of risk for any asset class, and the bigger the depth and also the length of drawdowns, that's the falls from the previous peak in percentage terms, the more stressful the asset class. And equity is a potentially very stressful asset class. So what I've done on this graph is to take some of the largest falls, peak to trough, for the S&P 500, and I've looked at the time to recover in terms of real total return. So you adjust downwards for inflation and you adjust upwards for dividends, which are reinvested. So each of these blocks you can see on the graph is one of those drawdown periods, one which would probably generate ulcers. So small falls from the peak are here on the right, and large falls from the peak are here on the left, and then the recovery time is along the y-axis. So long recovery times at the top and short recovery times at the bottom. So in this top left quadrant, you can see the most stressful ulcer generating region of the graph. And the periods which were most stressful and ulcer inducing were 2000 to 2013. That was a very long period. Also 1973 to 85, and a period long ago, which was 1929 to 1936. But notice how there is this relationship between the depth of the fall and the recovery time, which is just intuitive. It simply takes longer to climb back up in percentage terms if there's been a bigger fall in the first place. One of the key drivers of the recovery time for stock markets after a crash is whether the country enters a recession. So this graph is taken from Deutsche Bank research, and it actually shows the time to recover depending on whether there was a recession or whether there wasn't. And this is for episodes where the fall, peak to trough, was 10% or more, which is called a correction. The beige bars on the right that you can see here are the ones where there was a recession, and the median or typical duration of the drawdown was 280 days. Whereas when there wasn't a recession, it was a much shorter recovery time. Then it was only 60 days. So the markets recovered 4 times as quickly if there wasn't a recession. I've also done my own calculations, which you can see here, and I've marked on this graph the periods when there's a recession. Those are the light blue bars here. And I've also shown the peak to trough falls, which lasted more than a year. For the table which is beside me here, I've shown the peak to trough falls for periods of 0.3 years or more. So there are more of those, of course. It just made the graph a little bit too cluttered. But what you can see fairly clearly is that when there is a recession, as there was in 2008, but also in 2001, we do tend to get periods of drawdown which last much longer. Another long period to recover was between 1973 and 1980, so that was almost 8 years, and that coincided with the oil shock in the United States, and also a period of very high inflation. Now this makes intuitive sense, because if there is a recession, that would lower earnings growth for companies and also increase the amount of fear that's around in markets generally. The depth of the stock market fall is also affected by recessions. And this graph you can see beside me here from Goldman Sachs Equity Research shows you the median or typical fall during a recession in the United States for the S&P 500. The typical fall is around 24%, but there is a lot of dispersion. Sometimes the fall is as little as 14%, and it ranges all the way up to 57% in 2008. But it turns out there's another factor which is much more important in determining the length and the depth of these recovery periods. And we'll come on to that after we hear about NordVPN, our sponsor. Now, if I'm out and about and I want to access my brokerage account, if I use NordVPN, it's much more secure because it encrypts all of the traffic between me and my brokerage account. That way, if someone does intercept my communications, they won't be able to work out my password. Now, if I'm abroad and I want to access my UK brokerage account, I could appear as if I'm doing that from the UK by switching to a UK VPN server. That way my brokerage account will just assume I'm still local. Just to show you how easy it is to use NordVPN, say I'm logging into my broker, which is Vanguard, all I have to do is click on this extension button in my Chrome browser, and I can then very easily choose one of these VPN servers from some other country or from the UK. So let's choose the UK, and now you can see that the icon has switched to GB to show that my traffic is now encrypted and protected by NordVPN. And then to disconnect, I'd simply click on that again and click on the disconnect button. So it's really very easy to switch it on and off. And if I'd wanted to, I could have chosen a server in any of these other countries. Now for users of PensionCraft, we've got a special offer such that you get 1 month free, and on a 2-year plan, you get a 60% discount. Now I've never noticed any lags that you get when you're logging into a NordVPN server. They're certainly lightning fast. You get access for 6 devices. You can access it from 60 different countries, and you get a 30-day money-back guarantee. And to access that offer is very easy. Just go to nordvpn.com/pensioncraft and use the promo code PensionCraft, which is the name of our channel. You'll also find a link to that in the description below. It turns out that for the stock market, an earnings recession is much more important and damaging than an economic recession. So this is a logarithmic graph showing you the earnings or profits generated by the S&P over a 140-year period. Now, of course, there are huge fluctuations above and below a trend. These big falls would be called an earnings recession. And certainly recently, we got a small earnings recession during the pandemic, but since then, US earnings have surged. Now, this is what ultimately drives the S&P upwards. And that's because the price of the S&P is just a multiple of this earnings number. So as this gradually increases, the price to earnings multiple ensures that the price also gets pushed up, plus or minus some kind of euphoria due to the earnings multiple. Now in this top panel, what you can see is how much that earnings graph has fallen from its previous all-time high. So in other words, this is the drawdown for profits for companies in the US. Now this is related to economic recessions. Those are the shaded blue bars. And when those occur, usually you also get an earnings recession. But sometimes you get a blue bar without an earnings recession, or an earnings recession without an economic recession. And in this bottom panel, you can see the drawdowns for the S&P 500. Notice how when there's a very deep and prolonged earnings recession, you tend to get these very deep and long drawdowns for the S&P. That's not surprising because what really matters for US stocks is US profits. And now if we look at the peak to trough fall in the earnings, which we just saw on the previous graph, and plot that versus the recovery time during these drawdowns, you can see there's a pretty strong relationship between the two. So small drawdowns in earnings are on the right-hand side of the graph, large falls in earnings are on the left, and the recovery times are shown on the y-axis. So here on the top left-hand side of the graph, you can see periods when there was a big earnings fall, but also a long recovery time. So the double crisis between 2000 and 2013, first the dot-com bubble burst, then we got the global financial crisis, and ultimately we had a 13-year drawdown. That coincides with a very large peak to trough fall in earnings, which was more than 75%. But the huge stock market fall between 1929 and 1936 also coincided with a very large earnings fall, as did the stock market crash around the First World War between 1916 and 1924. And another episode was the Second World War between 1937 and 1945. Not only does the depth of the earnings recession affect the recovery time, it also affects the depth of the equity market fall itself. So again, we've got earnings fall, peak to trough, on the x-axis, with the largest falls on the left and the smallest falls on the right. And the y-axis is how much the S&P 500 falls, peak to trough. And again, what we can see is that when we get the biggest earnings falls here in the bottom left, that's when we also get the largest falls, peak to trough, in the S&P 500. That was true in the double crisis between 2000 and 2013, the episode in World War I, and the episode around the Great Depression between 1929 and 1936. Now that begs the question, are we about to get an earnings recession right now? Here are the quarterly earnings for the S&P 500 going back to 2013. The blue line is the reported earnings and the red line is the forecast earnings. So right now we're getting the Q1 2022 earnings and it's looking like it's going to be single-digit growth. Not incredible, but not a disaster. And if we look further ahead, you can see that there's still earnings growth going into each of the quarters ahead. Usually the comparison is based on the previous year. And all of the forecasts that you can see here show an annual growth. So there isn't an earnings recession at all that's forecast right now. Usually brokers are quite optimistic. It takes them a while to factor in any kind of negative information. You could say that they're always cheerful. And certainly if we compare the profit margins, that's the percentage of the top line that makes it into the bottom line for a company, those margins are at record highs or very close to them. Here we've got a comparison between today's margins versus March the 31st. And really none of them have been revised downward by much. And in fact, some sectors have actually had their margins revised upwards. Now that's a little bit surprising given what we're seeing with inflation, because input costs for companies will also be affected by higher prices. Maybe they can carry on passing that to their customers, but if they can't, they're going to have to take a margin cut. So it's been quite a shock recently when many large retailers in the United States, such as Target, which you can see here, reported that their margins have started to fall as a result of inflation. So here's a comment from the CEO of Target, who said we were less profitable than we expected to be. Looking ahead, it's clear that many of these cost pressures will persist in the near term. Now, the equity market in the US is very brutal at the moment for any disappointment in profits or in margins, and several retailers have had particularly sharp falls. These are not small companies. So, for example, Walmart is down about 20%, Costco down about 25%, and Target, which we just saw the results of, is down over 30% year to date, and Amazon is down even more. All of these, to some extent, have been affected by higher costs. So I think it's unrealistic to expect that margins wouldn't fall across many US sectors. That in turn is going to affect profits. In summary then, what really matters is how long we're going to stay in a high inflation environment. Because the longer US inflation persists, the greater the negative effect on US margins. And lower margins could drive an earnings recession. That would lengthen and potentially also deepen the sell-off that we've already seen. So I think this is a really nice example of the interaction between macroeconomics and markets. If we get an extended period of high inflation, that could drive down margins, create an earnings recession, and that could both deepen and extend this sell-off that we've already seen in 2022. So let's just hope that doesn't happen. Remember our offer from our sponsor, NordVPN. If you want to learn more about that, just click on the link in the description. And remember our promo code, which is PensionCraft, the name of our channel. And if you want to join our membership, you can do that on PensionCraft.com. And as always, thank you for listening.